Ladies and gentlemen, welcome back to the channel. My name is John, and today we need to talk about stocks to avoid. Stocks that you should avoid are ones that do not have the following characteristics. You should avoid stocks that do not have double-digit revenue growth. You should avoid stocks that do not have double-digit revenue growth. All right, let's make it through this intersection alive. You should avoid stocks that do not have double-digit EPS growth. This is crazy. You should avoid stocks that do not have net income double-digit growth. All right, come on. Come on. There we go. Everybody out of my way. Coming through. You should avoid stocks that do not have buyback. Although that could be one that you think twice about. Because the question is, what are they doing with their capital? What are they doing? Are they reinvesting in CapEx that's going to increase their revenue, increase their TAM? Are they building new factories? What are they doing with that capital that's going to generate more capital? And if they're not doing anything with that, then they better be doing buybacks and shrinking the total share count. Because the beauty of buybacks, when done correctly, when they shrink the total share count, is that you can take a company that, let's say over 20 years, they 10x their revenue. But if they were performing buybacks and buying back 2% of their share count, shrinking the share count 2% every year for 20 years, then that means you shrunk the share count by 40% in 20 years. So you 10x'd your revenue, you 10x'd your net income, right? But your earnings did not 10x, they more than 10x. You see, because that net income that 10x'd is now being distributed amongst a 40% smaller amount of shares. You see, so you're getting a double whammy. This is the beauty of buybacks. Most don't understand. But you could have a company where net income 10x's, but the EPS 15x's, 20x's. And if the EPS 15x's, 20x's, what do you think the stock did? 15x, 20x. But John, the business only grew 10% or 10x. Yeah, but we shrunk the share count. So I'm a big buybacks guy. I'm a big share count reduction with buybacks type of guy. Now, if a company is earlier on in their life cycle, I'm okay with no buybacks. I'm okay with that. But they better be growing that TAM. They better be growing their revenue. They better be growing the net income. So what did we discuss? We discussed revenue growth 10% or more. Double-digit revenue growth. Double-digit net income growth. So, of course, you're going to have double-digit EPS growth. Multiply all that by buybacks. What are you left with? You're left with some great businesses to look at. Put that as your filter and look at businesses that do that. You'll find some good stuff there. Now comes the question. This is the hard part, is the valuation. Does the valuation make sense for the business that has all those characteristics? Because, like, right now, some of these semiconductor companies, they check all these boxes, maybe not the buyback box, but they check the other boxes really well. Really well. But their valuation is starting to get a little insane. So it's a good thing we've seen this little pullback in the market, because this pullback in the market is going to let us reassess, reevaluate these companies. There's still a few that I think are buying opportunities. I still like the NeoCloud, but like Marvell, she went crazy. And yes, I do think it'll be even higher 2 years from now. But if we can get a nice pullback, maybe I can lock in a couple more call debit spreads at a 5-6x. Anyways, that's a short little video I have for you guys. Avoid stocks that do not have those characteristics that we talked about. Make sure to like the video. Make sure to get subscribed if you like this type of content. And comment below your thoughts on what stocks to avoid in this market. What characteristics do you need and do you need to avoid? Stay healthy, stay wealthy, and stay tuned for the next one.